What if I told you there's an ETF sitting quietly in millions of retirement accounts right now, and almost nobody online is talking about it? No hype, no flashy ticker symbol trending on social media, just a slow, steady, almost boring strategy that's quietly paying people's bills every single month. Retirees found it, financial advisors don't advertise it, and once you understand how it actually works, you'll wonder why it took you this long to hear about it. This is Knox, and on this channel, we break down the real strategies behind smart, automated investing. Before we go any further, hit that like button and subscribe right now, because today's video is one you'll want to come back to. This secret ETF strategy isn't about get-rich-quick promises. It's about something far more valuable: consistent income, lower stress, and a portfolio that works for you even while you sleep. Stick with me, because by the end of this video, you'll know exactly what this strategy is, how it works, and whether it deserves a spot in your own portfolio. Let's get into it. So what exactly is this secret ETF strategy that more and more retirees are quietly using? It's not one single magic ticker. It's a category of ETFs built around something called a covered call strategy. And once retirees discover it, many of them never look back. Here's the problem it solves. When people retire, their biggest fear isn't market crashes. It's running out of income while their savings just sit there. Traditional advice says, buy dividend stocks or hold bonds. But dividend yields on many blue chip stocks hover around 1 to 2%, and bond yields haven't exactly been thrilling either. Retirees need cash flow now, not just growth that might pay off decades from now. That's where covered call ETFs enter the picture. These funds do something clever. They hold a basket of stocks, often big, well-known names, and then they sell call options against those holdings. In plain English, they're essentially renting out the stocks they already own to other investors and collecting a fee for doing it. That fee is called a premium, and it gets passed along to shareholders as monthly income. This is why funds like JEPI, JEPQ, and QYLD have quietly built massive followings among income-focused investors and retirees over the past few years. Let's break down why this appeals so strongly to people in retirement. First, the income is often distributed monthly, not quarterly. If you're relying on your portfolio to help cover rent, groceries, or medical bills, monthly payouts line up much more naturally with real-life expenses than the traditional quarterly dividend schedule. Second, the yields are significantly higher than standard dividend ETFs. While a typical S&P 500 index fund might yield around 1.5%, many covered call ETFs yield anywhere from 7 to 12% annually. For someone with a $500,000 portfolio, that difference can mean tens of thousands of extra dollars in income per year without having to sell a single share. Third, and this is the part most people miss, this strategy can reduce volatility. Because the fund is collecting premium income regardless of which direction the stock moves, that premium acts like a cushion during choppy or sideways markets. It doesn't eliminate risk, and we'll talk about that honestly in a moment, but it does smooth out some of the bumps that make retirees nervous. Now let's talk about how the mechanics actually work, because understanding this is what separates someone who uses this strategy wisely from someone who gets blindsided by it. When a covered call ETF sells a call option, it's giving another investor the right to buy the underlying stock at a specific price, known as the strike price, before a certain date. In exchange, the fund collects a premium upfront. If the stock stays below that strike price, the fund keeps the stock and keeps the premium. That's the ideal outcome. But if the stock rallies significantly above the strike price, the fund has to sell those shares at the agreed price, which means it caps how much upside it can capture during a big rally. This is the trade-off retirees are making, often without even realizing it at first. They're exchanging some potential upside during major bull runs in exchange for higher, more predictable income right now. For someone still in their 30s trying to grow wealth aggressively, that trade-off might not make sense. But for someone who is 65, already sitting on a solid nest egg, and who cares more about steady monthly cash flow than chasing the next 20% rally, that trade-off can be incredibly appealing. Let's talk numbers for a moment, because this is where the strategy really clicks for people. Imagine a retiree with $400,000 sitting in a taxable brokerage account. If they moved a portion of that, say $150,000, into a covered call ETF yielding around 10% annually, that's roughly $15,000 a year in income, or about $1,250 a month, generated automatically without selling a single share of the underlying investment. That's the kind of predictable income that can genuinely change someone's retirement lifestyle, covering a mortgage payment, healthcare premiums, or simply giving them breathing room every single month. But here's where we have to be honest, because a video like this isn't complete without covering the risks. Covered call ETFs are not risk-free income machines. The share price of these funds can still decline if the underlying stocks fall in value. The premium income helps offset losses, but it doesn't fully protect against a serious downturn. Some of these funds have also shown what's called NAV erosion over long periods, meaning the actual share price slowly decreases over time even while distributions stay relatively high. This doesn't necessarily mean investors are losing money overall, since the income often makes up for it, but it does mean this strategy needs to be understood clearly, not blindly trusted. Another important point: the tax treatment of this income can be more complex than standard qualified dividends. Depending on the fund structure, some of the distributions may be taxed as ordinary income rather than at lower capital gains rates. This is exactly why more and more retirees are holding these ETFs inside tax-advantaged accounts like an IRA, where the tax complexity becomes far less of a headache. So who is this strategy actually built for? It tends to make the most sense for people who are already retired or close to retirement, who prioritize monthly income over aggressive growth, who understand they're trading some upside potential for consistency, and who are comfortable holding these positions inside a retirement account for tax efficiency. It tends to make less sense for younger investors with decades of compounding ahead of them, since capping upside during strong bull markets can meaningfully slow long-term growth. There's also a psychological benefit that doesn't get talked about enough. Retirement isn't just a financial transition, it's an emotional one. Watching a portfolio balance swing up and down every day can be genuinely stressful when that portfolio is your paycheck. Many retirees say that seeing consistent monthly deposits land in their account, regardless of what the news cycle or the stock market is doing that week, gives them a sense of calm that a fluctuating account balance never could. That peace of mind is part of why this strategy is spread so quietly and so effectively through retiree communities, financial forums, and word of mouth without needing flashy marketing campaigns to sell it. To automate this in your own portfolio, the general approach many people use looks like this. They allocate a defined portion of their portfolio, often somewhere between 20 and 40%, into one or two covered call ETFs. They set up automatic dividend reinvestment during years when they don't need the income yet, letting the payouts compound. Then, once income is actually needed, they simply switch reinvestment off, and the monthly cash starts flowing directly into their bank account. It's a strategy that can be almost entirely automated, checked on quarterly rather than daily, which is exactly the kind of low-maintenance system this channel is all about. So, there it is. The quiet ETF strategy that's been steadily gaining ground in retirement portfolios everywhere. Not because it's flashy or trending, but because it actually solves a real problem: reliable monthly income, reduced portfolio stress, and a system that can run largely on autopilot. It's not magic, and it's not without trade-offs, but for the right person at the right stage of life, it can be a genuinely powerful tool. If this video helped you understand something new today, that's exactly why this channel exists, to break down real financial strategies without the hype and without the confusion. If you found this valuable, make sure you're subscribed so you don't miss the next breakdown, and drop a comment letting me know if you'd want a deeper dive comparing specific covered call ETFs side by side. This is Knox, thank you for watching, and I'll see you in the next one.